Welcome to the Daily Brief, where I'll quickly go over the action in the market for Tuesday, August 16th, and then see how things look for Wednesday, August 17th. And I'll only be preparing a Daily Brief video since there wasn't a really big change from Monday's session to Tuesday's session, but there are some things just to make you aware of and things that we want to keep an eye on. So let's go back and talk about what happened. We ended up being up 0.19%. It was an up day. The S&P did advance, not by very much. However, it had been up a lot more during the session. It went up to the 200-day moving average and then fell back below that. So that's one area that we want to keep an eye on. Volume ended up still being below average. And the technicals, they're still positive, but we're starting to look a little bit exhausted right now. We have a lot of our short-term and intermediate-term indicators that are giving us extreme positive readings. We have the 200-day moving average above where we're at right now. That's pretty significant resistance. So for the market to stall out a little bit here is not necessarily surprising. Inflation and interest rates still are the main concerns. We also have a whole list of geopolitical concerns, earnings as they're released, and then, of course, the debate that continues back and forth. What is a recession and are we in one? So what are some comments that we can make? Growth underperformed in Tuesday's session, but the sector rotations and the positive setups that we're looking at, they're still positive. A few of them declined a little bit, but they're still holding up fairly well. The S&P sold off after testing the 200-day simple moving average. Now, on a more positive side, there's a thing called the S&P 500 equal weight index. The S&P 500 that we focus on is weighted, which means the bigger stocks make up more of the impact, whether the S&P goes up or down. Well, there's another index that takes all of the stocks in the S&P 500 and treats them the same. Well, that equal weight index did go above the 200-day moving average. We also had the Dow, the small caps, mid caps. They also went above their 200-day simple moving average. So that's positive. It just means for right now, the S&P is lagging a little bit. However, the NASDAQ and the NASDAQ 100 are still well below their 200-day moving average. If we can see all of these indexes cross above at the same time, that would be more confirmation and it would make things look more positive. If we see them start to go up to those levels and then come back down, and then we see some of these other simple moving averages that have already crossed above and they start to come back down, that would be a bit more of a warning sign, just to suggest we need to be careful with things. That's why we do intermarket analysis. And then looking at some of the charts, we're looking a little tired right now. So I'm calling this internal exhaustion. We've gone up pretty strong. We're getting to overhead resistance and we're kind of running out of gas as we're getting close to that level with the S&P. Now, some other indexes are still looking okay. We're waiting to see what the NASDAQ and the NASDAQ 100 will do. The 10 to the 2, the 10 to the 5, they still remain inverted. The 10 to the 3 month is still positive, but it's still pretty close to going inverted. Greed is increasing. We've now come out of the neutral area as far as sentiment, and we're going above 55 now. So we're now into the greed side of things, but that's not extreme. We only really pay attention to this when we see extreme fear or extreme greed. Oil has actually dropped. It's down to 86.53. So that's probably helping gas prices. The economic reports that came out, it showed that housing starts were down 9.6%. Again, we're seeing more weakness in the economic reports. This was on a month-over-month basis. And building permits, which is a leading indicator because you have to go get a permit before you can start to build anything, they declined 1.3% on a month-over-month basis. Industrial production was actually stronger than expected. It came in at 0.6% on a month-over-month basis, an increase where they expected it half of that. They only expected it to be up 0.3%. And capacity utilization it increased. This is how much are the machines and factories and things that are available, how much of them are actually being used right now. And it increased to 80.3%, where they expected it to be 80.2. So just a little bit stronger than expected. Our trend is still positive. The ADX is above 20 and the green line continues to be on top. Because we're still having up days, I'm keeping the bias as positive, and the last few days have been positive. So the momentum continues to be positive as well. So then what's our outlook for Wednesday? The technicals, yeah, they're positive, but they're becoming overbought, short term and intermediate term. And we still have the 200-day simple moving average above where the S&P is at right now. Sentiment continues to advance. That could be positive until it gets really, really positive. The reports coming out on Wednesday are the weekly MBA mortgage index. Retail sales, that's a biggie because retail sales make up a huge part of the US economy. We have business inventories, not necessarily a big report, but because if companies are making things and they're not selling them, then they have to hold on to them. That means that their inventories are starting to increase, and you want to have some things on hand, but you also want to be able to sell things, get rid of them and produce more. Then the big one is probably going to be the FOMC minutes. They will be released at 2 p.m. Eastern time. The markets will read through there, try to figure out who voted for what was said during the meeting. Even though this is old news, there might be something new that ends up coming out. So there may be a reaction to that. We have the whole list of geopolitical events. The main thing for the stock market is inflation and interest rates. But as I keep saying every day, Russia, Ukraine, anything international, anything inside the US that could impact the stock market, if something blows up and gets out of hand, that could come to the forefront at any time. So what are our scenarios? We're not really looking at a down scenario, even if we see some kind of a short-term pullback for all the reasons that I just talked about, because the S&P is short and intermediate term overbought, and we still have resistance above where we're at. We might see things really fall down, but it's not really switching over into anything strongly negative, at least at this point. Technicals are positive, but we might be starting to see some internal weakness. We are still going with the up scenario, but things are overbought and looking a little bit weaker. There's still this disbelief thinking that this is just a dead cat bounce and that you can't really trust this. The market's just getting ready to go lower. Our evidence suggests, yeah, that could always happen. But we're seeing some things under the surface that suggest that strength has actually been increasing. We just may be ready for a pause. And then if we do really start to go higher, that will be the fear of missing out. Our scenarios are still looking okay. The sector rotation, the setups, all of those things are still hanging in there. Technicals are still positive overall. We still have the 200-day simple moving average to get above that. That would really change things quite a bit. We're not sideways right now. So our conclusion then is the S&P is positive, but overbought in the short and intermediate term. Short term overbought, intermediate term overbought. And as long as we stay below that 200-day simple moving average, we are still in a long-term negative trend. So thank you. I hope you found this informative. I'll still look over the charts after Wednesday's session to see if putting out a full-length video on Thursday is warranted. So have a great day, and I'll talk to you next time.